All right. Hey, you know who I am. It's Liquid Levy. We're going to do a very beginner class. A lot of you have just joined the Discord, this community. You haven't traded before. You don't know day trading. Maybe you've done a little bit of options or something with stocks and you've lost some money, but this video is for you. If you're just getting started, consider this class 1A. Um, We're going to keep it very basic, very simple. I'm going to keep it just casual and conversational like it is right now. We're going to go over, in my opinion, not a whole lot, but for you, probably a lot. Try to take notes, try to write stuff down or type notes, whatever, take screenshots, especially when I say this is important or take a screenshot. It's going to be highly beneficial for you. You're going to want a little note section. You'll want to come back to those notes. You'll want to ask me a question. Maybe not in the live, but you can DM me on any of the platforms and reach out and just get some answers. But I also do in the Discord have a miscellaneous section. It says like MISC. It's down in the education tab in the Discord, and in there are different links. There's a trading journal that can help you. So right there is an Excel spreadsheet. Make a copy of it. I think that is like the master. So make a copy, and you have now an accountability spreadsheet for yourself. And if you ever want me to mentor you, I can do that and I can analyze your trades. You can show me, and I have videos, and you can later learn how to actually submit a trade. But that's how we're kind of going to get you going here and understanding things. So, first, what you're looking at are two different charts. They look very alike, but on the top left here, you see S&P 500, and on the right, you have this one, NASDAQ 100. And so this is the NASDAQ 100, and this is the S&P 500. You're looking at the daily. That's why it says 1 day, the D here, 1 day. So every candle, every one of these is a day in time period. Obviously, the green candles are when price is going up. Red candles are price going down. So this is a green day. Green days, this is a bad day. That was a red day. Very bad day, red day, red day. And you can see price goes up and down, up and down, up and down. But on the day, it mostly has a direction it likes to go. But what we're looking at here is the future index, or rather the future indices of the NASDAQ 100 and the S&P 500. So you've probably heard on the news, you've watched like Fox, CNN, and NBC, whatever it is, and they've said, oh, the Dow went up 50 points, the S&P went up 100 points, and the NASDAQ went up 200 points. And that's also how it usually does. The Dow moves the least, then the S&P then moves a little bit more, and then the NASDAQ is probably the most volatile. And you can do the research yourself. There's 100, as it sounds, NASDAQ 100 companies in the NASDAQ 100. They're mostly about a good third to half is tech, software and tech. So you've got your, Microsoft, Google, Nvidia, Broadcom, Tesla, all those, plus also like Costco and some other companies, but mostly the NASDAQ 100 lives in the S&P 500 because that's 500 companies of the greater New York Stock Exchange, the 500 largest. And so you have some big companies like Visa, MasterCard. I believe those are in here too. But they have different weights. They have different values in each. And you can do that research and check that out. But you can see how they're very strongly correlated. You can go to the 15-minute here and you see basically the same thing going on because they are very, very correlated. And essentially, um, before we get into anything, I wanted to show you the candles a little bit more so you understand that. So you already know green is a good candle, red is a bad candle. I guess you could say green is good price going up, red is price going down. How you can read the actual candle here, if we zoom in on this one right here, okay, we have the body, of the candle, and we have wicks. Those are those green little things sticking on either side. Those are your wicks. That's the body. That's the body. That's a wick. Teeny weeny little wick right there. See that little wick? Little baby wick? But that's the candle. That's it. The body and the wicks. That makes up the whole candle. A green candle opens, price begins at the bottom of the body, and it ends, it closes at the top of the body. So how you can read this particular candle is that price opened here, came down, back up through here, and then closed here in the time frame that you're looking at. Now remember, we moved from the daily to the 15. So you're looking at a 15-minute period where price opened here at 23,780-ish, came down to about 725, all the way up to 845, and then closed there. And so it tells that story. So you can read that now in the candle. A red candle does it basically the same, but just flipped, opposite. So a red candle will open at the top of the body and close at the bottom of the body. So this particular candle opened here, came up a little, has that wick there. It's hard to see, I have a trade there, a winning trade, as most are. A wick here came up, came down through here, created the wick, and closed there in that 15-minute period. And then right here, you can see the open, came up, came down, and then closed here. Opened here, up, down, little wick, closed here. This candle then opened, dipped, and closed right here. Open, close. And that was actually a good reversal yesterday or Friday, 2 days ago, for a small long, but we'll get into that later. But that's the candle. And so price moves up and down. Up here being premium, down here discount. Premium, discount, premium, discount. Price moves up and down all the time. Up and down, up and down. You see highs and lows all the time. Here's a major high, here's a major low. And then it makes a high, low, high, low, high, low, high inside of these highs and lows. We call this, mostly when it's out here, an external, and there's nothing really out here outside of the price. Call that ERL, external resting liquidity. And down inside here, we would call this internal resting liquidity. This would be your ERL sell side, ERL buy side, because again, sell side discount, buy side premium. And these would probably be your internal resting liquidities, these different significant lows and highs. So this is your most significant high of this whole time period because this is the most high, and this is a significant low because it's the most low other than that. Now, to further dissect highs and lows, you have swing highs and swing lows. Those are just 3 candle formations where you have a high, higher high, and a lower high. So that's a swing high. That's a swing high. That's a swing high. That's a swing high. And that's a swing high. Swing lows are just a low, lower low, and a higher low. So that's a swing low. That's a swing low. Cramping up here. That's a swing low. And believe it or not, that is a swing low. This low here is a swing low. And what you need to understand is that as price is moving from premium to discount, inside of those highs and lows, or rather just outside of those highs and lows, so just above here and just below here, are stop losses. So people are in trades all the time. People were anticipating a death candle here because of maybe poor NFP results, and we did get very bearish NFP, non-farm payroll or non-farm employment news. It's a once-a-month report. We'll go into that later, and if you come to class and go to the lives. But people were looking to short this, and then definitely did after the NFP results. And so up here are just stop losses. People shorting the market are going to rest stop losses above those highs, the highest high. And so because stop losses are resting here and resting everywhere in between, the market and what moves the market, the algorithm, is what wants to move and hit those highs and lows. Eventually, at some point in time, price will seek buy side and sell side, ERL and IRL. It likes to move from ERL to IRL. Um, and the way it moves from premium buy side to sell side discount is generated liquidity. Okay. It's just through liquidity in general. But what I mean by that is when we take a trade, when your retail trader takes a trade, we're using very small volume, very small liquidity. I can just push the button and get into a sell or a long position immediately by the market buy or sell button. I'm not asking price to get anywhere. I'm just saying fill this position. I could use multiple contracts and it would fill me immediately because there's liquidity there. Wells Fargo, some big institution, if they want to sell off 100,000, a million shares, or like 10 million, $100 million worth of an asset or in a fund, they can't just push that button. They have to generate the liquidity. Okay, so they actually need the amount of buyers in the market if they're trying to sell, because for every buyer, there's a seller. For every winner, there is a loser in the market. When you make $1,000 in the market, collectively, there's not like one particular person, but generally speaking, if you make $1,000, you can say that someone lost that $1,000. They had to, right? Now it's not one particular person. Now I'm sure one particular person did lose 1,000, other people a lot more. But you can, it's that liquidity. You're grabbing that $1,000 if you won $1,000 profit. You've grabbed that extra liquidity and taken it out. It's a realized P&L profit. Okay, and so the big institutions digress there big time. The big institutions can't just push the button. So if they want to cause a sell-off, they actually start buying. So that is what happened here. We had very bearish news, and the people who wanted to go instantly into a sell actually got completely destroyed here, and we pumped a bit, took out some more buy-side liquidity. We got into a short position here, which we should have held. It was a huge banger trade. It was a 3 RR. Could have been a lot more. But the institutions are going to buy, cause a lot of other people to buy, so they can then get the buyers in the market to flip that switch and start the enormous sell-off. And so this was this is market manipulation 101 right here. Okay, because again, for every buyer, there's a seller. Every winner, there's a loser. So when the big markets want to sell off the market, they start pumping a little bit. Markets going up, vice versa. If they want the markets to go up, they actually start dumping a little bit. They cause a dump session, and then people start getting into that. Retail traders, trend traders are typically going to want to follow that and do something like on the left. There's a breakout in trend. How we trade is we trade with the smart money, okay, with ICT, inner circle trading concepts. And so we do what's on the right. So instead of seeing a breakout here, we're looking for that reversal, that generated liquidity, and for it to reverse after you've taken out all the people wanting to go long because their support was broken. Okay, and that's exactly what happened there. There was the pump to the dump. Okay, so that's basic market liquidity, understanding the candles. Let me see if I'm not missing anything else. Other things to just understand with the futures market, first of all, is that it is just the speculative future price of the real indices. So you can only buy contracts, so you can't buy shares, stocks of NQ, which is what the Nasdaq future is called, or ES, what the S&P 500 futures is called, ES and NQ. You buy contracts. Okay, so we'll get into that, but basically on main NQ, every contract when a dollar moves on NQ, you're getting or losing $20. And I'll show you how we can use micros there and do a tenth and scale it. And then with ES, it's actually $50 per point or per dollar moved on the chart on ES. $50 profit or loss. So it moves quick. Gains and losses move quick too. So you have to mitigate and preserve. And we'll go into how to take a trade. I have classes on that, recorded class sessions, lectures on how to take a trade, how to move stop loss to break even. But for you right now, understanding liquidity, you've now got a little understanding of how the market moves up and down and why, it needs to take people out. There's a lot of tricks in the market. You need to know that. So points are dollars, ticks are quarters. So when when ES here goes from 6490 to 6490.25, it went up a tick. But if it went from 6490 to 91, it went up a point. Okay. The other thing we'll get into here, and my apologies, I just assume things. You don't know a lot about trading here. Are fair value gaps. Fair value gaps are how ICT traders trade, and it's how we see and anticipate a reversal coming. And so you can see how there's fair value gaps leading up to this reversal. This is a higher time frame. This is the 15-minute. You don't usually take a trade on the 15-minute. But what you see here is price came up above what's labeled here as Asia and London. And those are just time periods. The Asia session, because from the New York Eastern time zone, Asia is 8 p.m. to midnight Eastern, because 8 a.m. to noon is their trading hours. They're 12 hours ahead. London is 2 a.m. to 5 a.m. Eastern, because they're about 5 or 6 hours ahead. And so that puts them at about 7 or 8 a.m. Okay. And so when these sessions get taken out and run, these are, previous day or daily highs taken. They're big liquidity pools. So, we as an ICT trader, we typically look for a reversal, first of all, when Asia and or London highs or lows are swept. And that's when price takes those out. This one a lot higher. It did. We created a fair value gap, multiple. And so what I want you to understand, a fair value gap is just indication of heavy institutional trading. It's when there's a lot of major trading in that time period. And in this case, major selling. Okay. There's how to identify a fair value gap is it's typically a 3-candle pattern. It's just so that you could see the middle candle here. The body has no wicks inside of it. This right here is your gap. You can even connect the gaps. This is one whole giant gap here. See that? You can connect these two. But for the sake of just the 15-minute, that gap is this. And for learning purposes, this is a bearish fair value gap. Okay? And what happens is price acts as liquidity pools inside these gaps. And it usually acts as pressure in whichever direction. So if it's a red or bearish candle, price will come up into these and typically want to react bearishly from them. Price will want to come up and it'll get pushed down. We can power through this, but this is a heavy roadblock for price to come up through. Okay, it's going to be a lot of work. Same thing on the other hand, when we saw price take out here, and it was the reason why we would have looked for longs in this case, as price came down, not only took out all this sell side, but we wicked into, if you look to the left, a bullish fair value gap. So this acted almost like a trampoline, and this put pressure in the other direction to launch price back up bullishly. That's what fair value gaps are. They're kind of those liquidity pools that price it magnetizes price to, but then it helps to react and get price moving in the direction that they represent. So a red bearish candle, price wants to get in and then come down from. That's when they deliver. When price delivers from a fair value gap, it's reacting inside of it and continuing in the direction that it is. So red bearish going down from coming up here and sweeping IRL, internal resting liquidity, buy side. Okay, even though in this time period we're in discount, because you can see this here, that is a Fibonacci tool. You can just make one over here in Trading View. And all it is you just pan your cursor across a period, marking out a high and a low, and it gives you the 50%, the middle. And so at any point in time when you've had always up to date the highs and lows, you can update and say, well, this is your discount, this is your premium. Above the 50% is premium, below is discount. All right. But for fair value gaps, it just indicates institutional trading. It acts as a liquidity pool, a magnet. Price came down, immediately delivered, and bounced off of this bullish fair value gap and came out. So now you understand fair value gaps. You understand how liquidity works, liquidity pools in fair value gaps. What else can we do? That's pretty much it for beginner. Time is also fractal, I want to mention. So at any time period, you can see this happen. So time price came up, came into a bearish fair value gap here, reacted down, came into a bullish fair value gap, came up, came down into another bullish fair value gap, came up, and it's constantly reacting. You can see it. It's quite predictable, but you'll see it gets tricky. And price, the algorithm is always wanting to take people out. What I mean by that is hit your stop loss, get you out of your trade and liquidate you. Okay, because when price hits your stop loss, when you're taken out of a trade, you're essentially buying back your position. So you're giving that money back to the market. You're the loser in that circumstance, and someone else has gained that liquidity, or it's still in the market being passed around, essentially. IRL, ERL fair value gaps, generated liquidity. That's pretty much it for now. I'm going to do some other lessons like on our A+ setup and the OSFL, one setup for life. Those are the number one ways we get into a trade. And with data candles, when data comes out, like here on Forex Factory, you get a bunch of red folder news when these data reports come out, such as last Wednesday, September 10th, PPI, there's a little volatility there and a lot of volume injection into the market. CPI, I'm sorry, this is this week. CPI coming up this Thursday, September 11th. CPI is going to give us a huge data candle. CPI is the most anticipated report of the whole month, and it will probably give us a candle of 100, 200 points or more. It depends. And so that I can show you how you can pass an eval account and get it funded in one trade. I can show you how we can use the one setup for life, OSFL, if we get a true data candle, which is when we sweep buy and sell side. But I'm going to save that for the next lesson. And we also have class twice a week. And this week, 3 times this week. We have it tonight, September 7th, tomorrow, Monday the 8th, at 8 Eastern. So please make sure to come. But that's it for this class. I'm sure I missed a couple high level beginner stuff. But you understand now, the candles, you have Forex Factory to find financial news. You understand fair value gaps, liquidity pools, generating liquidity with big institutions, and how you can become a not a turtle trend trader, and you can become this trader. You can look for turtle soup, turtle trades. And this is our A+ setup. We'll go into this next class. So that's it for right now. Thank you so much for your attention, watching, and being a member. I appreciate it. Please, if you can do anything, is spread the word. Share this Discord group, share the link, show your trades, your profitable trades, whatever, on Instagram or wherever you do, or just through word of mouth. I really appreciate it. So thank you so much for watching, and definitely pay attention to the other classes, the other recorded videos, because there's a lot of value in that and more to come. See ya.